Today I want to take a closer look at Intel and its recently announced partnership to help finance its push to the manufacturing market. As we all know, this is going to be a very expensive push and a very expensive investment for Intel. And this is not the first kind of financial solution the company has come up with this month. There was one earlier in August where they kind of even built up a bit of debt in their balance sheet. So in today's episode, I want to do the following. Take a closer look at this partnership and also the recent kind of debt it has built up. More importantly, I want to take a closer look at this company's financials balance sheet and try to see how things are looking. I do want to say right now, it's not a crazy red flag, but there are some yellow flags that investors should know. So let's get started.
I do want to thank The Motley Fool for sponsoring this video, and make sure to check out fool.com/Jose to get the top 10 stocks to buy right now.
So if we take a closer look, Intel right now is sitting at $33.95. If we take a closer look, this is very close to its 52-week low of $33.73. So as we can see, investors are definitely not happy with Intel. So on August 23rd, Intel announced that they signed an agreement with Brookfield to jointly invest up to $30 billion in leading-edge chip factories in Arizona. And as we all know, Intel is pushing into that foundry business, but that foundry business is very expensive. That's why there's only limited amount of players, especially in the advanced node, which Intel is kind of pushing into. So one way to kind of reduce that risk is by joining partnerships with Brookfield. So here in this slideshow by Intel, we can see that they are thinking of investing up to $30 billion for 2 new factories in Arizona, and the kind of partnership is going to be 51% Intel and 49% Brookfield. So they're going to kind of split the cost. Obviously, they're going to split the form of returns as well. Intel does want to let investors know that they are going to be full control of operations and IP control. So I do want to say this is a pretty cool move for Intel and a pretty good one to kind of reduce the risk. Obviously, by reducing the risk, you also kind of limit your rewards because now they have to return some form of contribution and distributions to their partner. But I do believe for starting off and to minimize the amount of burn rate in their balance sheet, this is the best move to start off with. And there are numerous ways that Intel could have built up their capital allocations. Here, for example, they mentioned some sources of funding, customer commits, government incentives due to the kind of like the CHIPS Act, cash flow from operations, equity partners like we just saw, and overall debt. So during the presentation, they do mention that this funding is expected to be higher than the cost of debt, but lower than the cost of equity. And there was a Q&A session during the presentation where they mentioned that their kind of debt offering was somewhere around 4.4% interest, and their equity offerings was somewhere around 8.5%. So this falls somewhere between that range. Obviously, because of the way contracts and non-disclosure agreements happen, they can't really disclose at the moment what the true value is. Some might be wondering, hey, Jose, if they can get debt for cheaper, why didn't they do that? And the answer that they mention is they want to conserve their balance sheet. If they can get $15 billion right now from a partnership and not take out debt, so they're willing to pay a little bit more to kind of protect that balance sheet. In my opinion, it makes sense. As you all know, I'm not an owner of Intel and I'm not a huge fan of the company at the moment, but that doesn't mean I believe everything they do is wrong. So for those not familiar, on August 5th of 2022, Intel actually brought in some debt for some senior notes due in 2027, others due in 2029, others due in 2032, 2052, and one even due in 2062. This total senior notes accumulated to roughly $6 billion. So we can see in the past 4 weeks, this company has tried to increase their overall funding. And again, I do believe it's for that huge push into the manufacturing market. As we saw, those senior notes are pretty far from now, so not something I personally would worry about. I mean, especially we saw one from 2062. But I do want to say investors should be careful. As we take a closer look, this company's total long-term debt before these senior notes was roughly $35.4 billion. They do have a nice amount of cash and short-term investments of roughly $27 billion, but I do believe this is going to continue to go down as this company needs to continue to invest into this kind of manufacturing push. And unfortunately, at the moment, this company's kind of cash flow from operation and free cash flow is not going to be enough. We can see free cash flow for this quarter was a burn rate of roughly $6.4 billion. We can also see total dividends was a burn rate of about $1.5 billion. And this is is a company that at the moment has not talked about stopping their earnings. In their most recent kind of analyst day, they do mention that one of the things they try to do is kind of return strong returns to shareholders. One of those ways is going to be through dividends. So at the moment, the company does have plenty of cash at hand to be able to continue to have this burn rate. But if things continue to go down, especially as this company is seeing a decline in revenue, things can look a lot scarier, especially as to one, they're seeing a huge growth in investment, and at the same time, they're seeing a huge decline in revenue. And both those things happening at the same time can kind of accelerate that burning of their balance sheet. And I think the company knows that, and for that reason, they want to do partnerships opposed to kind of build up even more debt than they can. So while I do think the partnership makes sense, and I think it was the right move, I do believe that kind of balance sheet deterioration that we're seeing right now is kind of a big yellow to orange flag for the company. So let me know in the comments below, what are your thoughts on Intel at the moment?